Regular Insight viewers recognize her right away as a valuable resource in planning and sustaining your retirement. She is Heather Foster, a tax advisor and fiduciary. Today we're going to talk about how mutual funds are taxed.
Yes.
Which I don't know that I understand. Are they taxed when we are putting money into the mutual funds or when we're taking money out of the mutual funds?
Well, sometimes neither one. And that's great. That's what I wanted to talk about, because I've had a lot of people come in for kind of second opinions that are going, I asked my advisor, why do I have this huge capital gain? I didn't take anything out of this fund. So explaining that to them and trying to help them understand where taxation comes sometimes with mutual funds can be a little bit tricky, because it's not that you have to put money in or take money out yourself to get taxed on these sometimes. If you're in an after-tax account, so that's all I'm focusing on, not IRAs, not pre-taxed accounts, but in true after-tax accounts. So you took money from your checking, your savings, money that's already been taxed, and you, let's say, invested it into a mutual fund, right? It's critical that you understand when you invest into that mutual fund, because mutual funds internally, so there's pros and cons to every investment, we know that. One of the pros is that they're very diversified, right? So when you buy into a mutual fund, you're buying into a portfolio of all kinds of different stocks and bonds and things inside of those that make up a very diversified portfolio. That's why you want to own it. But the fund managers themselves, their responsibility is to buy and sell positions in there. So what happens is, let's say you buy a mutual fund and you put $10,000 into it, and it happens to be right before they distribute their capital gains. Now, the capital gains is where maybe they've decided, because they either want to sell a stock or they need to raise capital, to sell something that they've owned for many, many years. Now, you're coming in as a new investor, right? You've not owned that mutual fund for years and years and years, but they maybe, let's say, bought a stock and now they're selling it at a huge gain. That gain is going to distribute down to you. Even though you didn't own that stock all that time, that gain distributes to you. And it effectively pays out, but it actually then reduces the net asset value of the mutual fund. Therefore, you may own more shares now, but your value is still $10,000. So you may get hit with a $1,000 capital gain, but you didn't do anything.
But you didn't gain any money.
And you did not gain any money.
Just a tax hit.
Just a tax hit. So people sometimes are going, wait a minute, what did my broker do here? I see this huge capital gain, and we saw several companies last year, very large mutual fund companies, distribute capital gains. They decided to sell some very long-term stocks that they held, which created these huge capital gain issues for people going, wait a minute, my value of my account didn't go up. Why am I getting hit with these huge capital gains? And that is why. So it's critical that, one, you understand and you watch for these things. They usually start announcing those capital gains rates around October, November, December of every year. Work with your financial professional, because you can try to help offset some of those gains and those tax liability by doing what we call wash sales. So look for positions internal of your account that maybe have some losses, so that you can offset the gains in the year in which this happens. It's critical for people, because if you don't plan for it, guess what? You're going to owe some pretty major dollars in taxes if you were not prepared for it, or if your advisor is not communicating that to you on a regular basis. So it is important also, when you buy in, if you're going to get hit with that potential tax liability, then you probably want to buy into the funds in the beginning of the year, so that you don't just happen to buy in right before that capital gain distribution happens. Therefore, you're the one on the hook to pay the taxes for it.
Is it always a good idea to buy into mutual funds at the beginning of the year?
It's really, you can look at the fund. So every fund is different. We're talking about ones that maybe have decent turnovers in them, so they're actively managed, buying and selling. They actually make what we call tax-efficient mutual funds. So basically, the advisors are looking at buying things that they're going to hold for a very long time. If you find one of those, really, then timing is not going to matter so much. Or tax-free mutual funds, so tax-exempt interests, so ones that, again, are buying into municipalities. That won't matter what time of the year. But generally, most mutual fund companies, they're not tax-favored. They are not tax-exempt unless you're strategically doing that. And instead, you're buying into that bucket of funds, and you really just don't know as an investor when that mutual fund manager is going to decide to sell off. So in those cases, it would be better that you're a part of it, or that you get out of it before that capital gain distribution happens.
It's just an example of why you should be in such close communication with your planner, with your financial advisor.
And your tax professional.
Yes, absolutely. Well, if you want some advice, whether that is as a consultant or whether you need somebody to help you figure out what you're going to do as a planner, you certainly can call Heather Foster. They will give you a free gift if you tell them, mention Insight. All you have to do is give them a call today, 234-2200, or check them out online, fosterfinancial.net. We'll be right back.